today's topic, which is startup valuation. So again, just to do introductions, I'm Zehra. I'm the Venture Fellow and Associate Lead, and I've been leading out the program that Republic has for undergrads, MBAs, and mid-career professionals who are interested in learning more about VC. I'll let Cheryl introduce herself, and then I'll talk about our speaker today.
Yeah, I'm the head of venture growth and partnerships at Republic. I've been here for the past 3 years and super excited to have seen all the growth. I'm also a scout for Lightspeed and an investment partner at the Community Fund. And at the same time, we've just created a community organization for Latinx folks, VCs who identify as Latinx, and it's called VC Familia. So, really trying to make sure that we build on this idea of community. The fact that you guys are all here means the world to Republic and to us, because we do believe in the power in numbers. And so, this is why I'm so excited to be here and to work with amazing people like Zehra, who's coming and joining us full time. So.
Yeah, super excited to be doing that right after I graduate from Columbia. And I do also want to shout out Venture for Pakistan, which is a group I recently got involved with. I'm Pakistani, and naturally, kind of similarly to Cheryl and everyone else at Republic, I feel really passionately about supporting people who are like me, who are interested in venture. But now I'm going to introduce Geri, who is going to be joining us in around the next 20 to 15 minutes. Geri Kirilova is a partner at Laconia. Prior to joining, Geri was a business associate at TechStars Internet of Things program, where she facilitated program operations and worked directly with 10 portfolio companies on customer acquisition, growth strategy, fundraising, and business development, and messaging and storytelling. As an operator, Geri managed a branch of Quiller Prep, a boutique educational services firm, leading hiring, training, sales, program management, client relations, and curriculum development. She is a graduate of New York University Stern School of Business and holds a BS in business with specializations in information systems and management. After Geri's Q&A, we will also be joined by another speaker who's going to kind of speak about the investing experience from the Republic perspective. But first, we just want to address the question, like, what is startup valuation? Simply put, startup valuation is the process of quantifying the worth of a company. Essentially, that quantity that you get is the valuation. For greater context, during the seed funding round, an investor puts funds in a startup in exchange for a part of the equity in that company. This is why valuation is important for entrepreneurs, as it also helps them in determining the equity which they have to give a seed investor in exchange of funds. It's naturally very important for an investor, as they need to know how much a company's share they will receive after giving funds to the founder during the seed stage. Essentially, this quantifiable stage can be a deal breaker or maker in the VC world when investing in certain companies. Valuation is highly involved and pivotal to building out a compelling thesis to invest in a particular company. Without it, it's almost like you're really going into a situation not really understanding the quantifiable aspect, which is really one of the most important. So during the rest of this presentation, we're going to be going into a few methods of valuation at greater depth. But to give you a high-level overview of what factors may be considered in valuation and how they might influence the valuation of a company, we're just going to dive into a few of those. So traction is one of a major factor that can impact the valuation for seed stage companies. This is largely because traction is essentially quantitative proof that there is customer demand and that a startup is poised for future success. It demonstrates a potential for development and growth. Another factor to consider is reputation. This is more of a fluid factor, as it's harder to quantify as compared to traction, and more something to just consider. Founders need to ensure that they are working to build brand awareness and their own reputation as a founder. This will speak to the company's capability to succeed within the VC startup space, but also the efficacy of communicating with founders. So another factor is the MVP, or a prototype of your product. Asking a founder, like, is there currently an MVP in progress? The progress of an MVP can influence the decision of an investor and when they're thinking of how they could quantifiably value a startup. Pre-valuation revenue. Revenue naturally is important for any company and for all investors when valuing a company. Depending on what stage the startup is at, does it have revenue or does it not? This can impact other factors that may be used as a proxy when assessing a company. distribution channels in the initial stages of a startup, it's likely that the product or services will be in preliminary stages too. Founders need to choose distribution channels which make the most sense for their company. Again, this is another factor that can impact a VC's perspective on valuation. The industry, if the startup belongs to a booming industry, it's highly likely that investors will pay a premium. These are factors that founders are often thinking about before they pursue investments from VCs. Now that you understand why startup valuation is important and what factors from the founder perspective matter the most, we can dive into a few methods that are most commonly practiced by VCs. So first, like, why is valuation important? The valuation that a founder and VC arrive at will determine what % of the company is sold and how much original investors get diluted. There are two types of valuation, pre-money and post-money. Pre-money is the value of the company just before the new investors add money, and the post-money is simply the pre-money plus the new investment. Even more so, valuation is used to track the efficacy and performance of a startup and founder over time. The quantifiable aspects of a company are not only important for the investor, but also for the founder as they continue to guide their business towards growth. Lastly, let's address the difference between valuation and valuation cap. I'll also let Cheryl jump in here to clarify further after this. A valuation cap is used for convertible notes and other non-equity investments, while a valuation is used for equity-based investments. Valuation caps essentially reward seed stage investors for taking on additional risk by giving them equity priced at the pre-money valuation in the later financing of a startup. These can range anywhere from 1 million up to 15 million. So just to give an initial example, a $5 million pre-money valuation with a $2 million investment leads to a $7 million post-money valuation. Intuitively, we can see how the numbers add up, but today we're going to explore the different valuation methods VCs and investors use. Due to inherent uncertainty and the fact that projections are not 100% reliable, there are some methods designed to enable an investor to find a good estimate. So we're going to be diving into a few of those methods now.
Zehra, and one thing, just going back real quickly, we are throwing a lot of terms at you guys. So just to be clear, pre-money is just, say, for example, it's 5 million, you add 2 million in investment in a new round, or you raised on Republic and it's 2 million. Then the post-money valuation of the company now is 7 million, which is makes a lot of sense because they just got 2 million of investment. And then one thing I didn't want to mention is, valuation cap is something that you see on the terms at Republic. And so we just wanted to clarify what the difference was for valuation cap. Cap is, at the end of the day, it's the limit of how much the highest limit of when the potential safe that we have, which I'll drop in the chat, what's the limit of how much the company will be valued at a time of conversion. And so I'll drop some more information in the chat there, but just wanted to take a step back. And then also, if you guys have any questions, always make sure to ask us, because we can at least, while Zehra is going through presentation, can also answer your questions there.
Yeah, for sure. Thank you so much, Cheryl. So yeah, as I had mentioned, we're going to kind of jump into a few of these methods and what they really look like. And again, we're going to be going over a few, and then really excited to have our guest speaker join us. And as Cheryl mentioned, if you have questions, put them in the chat. We have a few members from the Republic team who can answer some of your questions as I'm going through the presentation. So first, we're going to be talking about the Berkus method. According to Dave Berkus, this method assigns a number, a financial valuation, to each major element of risk faced by all young companies, after crediting the entrepreneur some basic value for the quality and potential of the idea itself. This method uses 5 quantitative and qualitative factors to determine valuation. If it's a sound idea, again, prototype, which is similar to MVP, as I mentioned earlier, if there's a high quality management team, strategic relationships, product rollout, or sales made. Each category adds up to 500K to the valuation, allowing the valuation to go up to 2.5 million. So then there is another method, which is the risk factor summation method. This method compels investors to consider risk factors that could be external, not necessarily inherent to the startup. You determine an initial value for the startup and modify it based on these 12 risk factors. And so I'm just going to go through them: management, stage of the business, legislation/political risk, manufacturing risk, sales and marketing risk, funding capital raising risk, competition.
You don't have to go through all of them. I think they can read it off the slide. Don't worry about that. And once again, want to be mindful here is that these are different types of valuation methods, right? It's an art and a science, to be honest. It's like and Geri can talk a little bit about that because she can also see what and kind of opine on what she's seeing in the market, because you've probably heard like valuations are crazy right now, like everyone's trying to invest in different types of startups, and so sometimes things that like a series A used to have valuations of like 10 million, 50 million, 15 million, and now we see series A that it's like Republic 36 million and like all these other things that have like, you know, valuations in the hundreds of millions. And so it's an art and a science because it really takes into account the internal factors and the inherent value of the company. But at the same time, it also has to do with the demand to invest in these types of companies, in how hot the industry is, right? Companies that are currently in the NFT space or in the crypto space have much higher valuations because people want to give just want to be a part of it and and founders then have more leverage in terms of saying how much they believe the value of the company is, right? So just want to be mindful. We're going through 4 methods. Different types of people have different valuation methods, and so it's something that, you know, you can't necessarily like be very firm on because it is part art and part science. So we're just going through all the different types of things that you should think about as you look at different types of valuations, you know, whether it's on Republic or other places, maybe through your own angel investing. So just want to be mindful there.
Yeah, for sure. And I think what's really exciting is that in a few minutes, when I ask Geri some questions, we are going to be covering those questions that are like, okay, how can I get experience in valuation? What does it actually mean to develop that skill set? And so I just exactly what Cheryl said, to reiterate, this is just a high level example of different methods that can be used. And I think it'll be really interesting to hear from Geri later on what that actually looks like in practice. But yes, these are a lot of the risks that are associated in the risk summation method. But just to move on, so again, considering what I had mentioned previously on the last slide, at this point, you can either add or subtract 250K or 500K, depending on whether the risk is positive or negative for the company and by how much. So this is just an example of what startup valuation could look like at that point. And so we have 2 methods to go into before I jump into the conversation with Geri, which is super exciting. The scorecard method, this is similar to the previous methods in considering a list of factors, especially some of the ones I mentioned earlier on in the presentation. So you start by looking at pre-money valuation of 5 to 10 similar startups in the same or similar vertical and region, and you find an average number. Then you determine how similar the target startup is in these. And so you can see that there is a breakdown in terms of different percentages and like a kind of a comparison. And then you would essentially add up the percentages and apply it to the average number that's found. And so then the last valuation method we're going to be talking about is valuation by multiples. Given
this is for a little bit later, right? So the one before, you go to the one before really quickly, just so that people can see it. This is also pre-revenue, but I think what's and once again, actually this is pre-revenue, but also I guess post-revenue, you know. So at some point you would have to, there's like you're taking all of these methods, figuring out what works in terms of getting the valuation, and then you go to the next slide. This is much more now when there's some traction, there's like, you know, they're starting to have revenue come through the door. And so basically, you know, EBITDA is earnings before income, taxes, depreciation, and amortization. Sorry, interest, taxes, depreciation, amortization. Oof. And so what essentially, you can read it yourself, but I think it would make just sense that you're essentially taking what's coming in through the door and then finding, based off of different comparables, finding out what the multiple is for that that type of industry, and then, you know, working to make sure that you know, it's in line with the status quo of that industry. So you can kind of go ahead after this. That makes sense.
Yeah. Yeah, I think we kind of show different valuation methods based on what stage the startup is really at. And for those of you who might have a little familiarity with valuation by multiples, it is also something that people do with public companies. So just to kind of wrap up this conversation before we get into a really interesting Q&A with Geri, given a startup's EBITDA, as Cheryl had mentioned, you can find a multiple that similar companies vertical or in maturity go for and multiply the EBITDA of the startup by that number. You will start with a reasonable range depending on the company, and after negotiations, you would meet with a founder at a point that both parties find agreeable. A lot of this will also depend on the terms of the deal. So again, this is more, as Cheryl mentioned, kind of an art form. You gain experience through this, and it's exciting because now that we've presented some of these valuation methods to you, you're going to be able to actually ask a few questions to our speakers in a really meaningful dialogue and conversation on how you can actually improve your skill set and gain more experience. And so I am just going to say thank you for the presentation portion and actually kick off the conversation with Geri, unless Cheryl has anything to add at this point before we get started.
No, I mean, I think that was a good overview. We tried to cut down on some of the things that we're trying to teach here because we did take into account all of the feedback from last week. And at the same time, once again, we will be sending over more materials to talk about valuations, how different people do it, and how it's really changing with the times, right? And so I think this conversation with Geri is going to be super important to really make it into put it into context for this day and age.
Okay, great. So I'm really excited to have Geri be joining us, and I'm really glad because I think, as I mentioned in the introduction, coming from so much experience, I feel like there's a lot that we can all learn from this. And so, Geri, I would love if you could just unmute yourself and let us know you're here, and I'm happy to start asking the questions and really get started with the conversation.
Hey, it's great to be here. It looks like one of the hosts has to enable me to start my video.
Let me figure that out right now. Okay, I think that should work.
If not, that picture looks way more polished than I currently look in real life.
We want to see your face for sure. Oh my God, no. 1 second. I'm not sure why I can't see this. Hold on.
I haven't looked that normal in 13 months.
This is true. I feel like same for me. Okay, I don't know why it's not showing. Okay, got it. And then great. You should be good to go.
Mm-hmm.
Oh,
perfect.
Look at you. A gem.
Thanks for having me. It's good to see you both and excited to have, it looks like 350 people here. Wow.
Yes. The community is very strong. Republic, that's the part that we love the most. That's why we're trying to give back. We had over 1,200 RSVPs, but that was really cool. So I feel like a lot of people didn't realize it's going to be recorded and they're like, So they'll see your lovely face later as well. But thank you so much for being here. Zehra is actually going to take the reins and moderate as she did last time. I don't know if you saw the one with Randy Zuckerberg. Crushed it. So
I haven't seen it yet. I'm excited to watch the recording.
Yeah, exactly. And I mean, I think you're gonna do just wonderfully. So everyone in the chat, say hi to Geri. Feel free to ask any questions along the way. I'll be hiding in the background, and Zehra, you can take the lead.
Yeah, thank you so much.
Great.
So I want to reintroduce Geri because we're going to be able to learn so much from her. And so Geri is a partner at Laconia, where she leads or co-leads seed rounds in B2B software companies. Prior to joining, Geri was a business associate at TechStars, Internet of Things program, where she facilitated program operations and worked directly with 10 portfolio companies on customer acquisition, growth strategy, fundraising, business development, and messaging and storytelling. As an operator, Geri managed a branch of Queller Prep, a boutique educational services firm leading hiring, training, sales, program management, client relations, and curriculum development. She is a graduate from NYU Stern School of Business and holds a BS in business with specializations in information systems and management. Thank you so much for joining us. I'm so excited to have you here.
Likewise, thanks for having me.
Yeah, of course. And so I think just to kick off the conversations, I'd love to kind of reflect back on your career and think about some of the moments that were most pivotal in your journey that kind of helped shape you, who you are now professionally and as an investor. I feel like you've had such a wide array of experiences, and I'd love to hear what moments you thought kind of really shaped where you are now.
Yeah, thank you. I appreciate that. One of the things about being in a venture role is that you always feel like you're drinking from a fire hose, or at least I do. So in many ways, it still feels like it's very early days. And I mean, objectively speaking, it is. I still have a long way to go in my career in general, but especially in my role as an investor.
Mm-hmm.
But it's always interesting to kind of reflect on these things every now and then. And when you kind of sent over this question earlier, I started thinking about a couple of different areas. One is, what are sort of the pivotal moments of me really understanding the investor landscape and what it means to have a role in it,
Mm-hmm.
and what is the value that I could potentially bring to this ecosystem, because there are so many people who want to be investors and who would be fully capable at this role. So what are the things that uniquely stick out to me that are interesting? And the other piece is, what are the early signs that I even have a shot at being any good at this? So tackling the first thing, it was very interesting because I got into venture very early on in my career. I was actually still in school looking for different entrepreneurial roles to play. I made the mistake of going to business school thinking that that's where you learn how to run a business. And I quickly found out that that's where you go if you want a very structured path into banking or consulting. And I spent a little bit of time flailing and figuring out, all right, well, how do I get to a more interesting and more dynamic early stage role that's involved in business creation? And I ended up finding my way to an early stage fund in Prague when I was studying abroad. And I just remember like the initial moments of discovering how venture even works, that there's, in theory, a pool of capital that is allocated to enable people to start businesses, even if they don't already have their own money, right? So you don't have to be rich to start your own business. Like that to me was sort of a light bulb moment of, wow, what a fascinating industry. This sounds really value additive. And then there were other moments that were sort of less positive in terms of their initial impact on me, like discovering that a huge chunk of venture capital money that goes into funds actually comes from institutions such as pension funds. And I remember having this moment of thinking, really? We're putting pension fund money into these extremely high risk companies? Like, that doesn't sound like it makes sense on the surface. And of course, the more you peel back the onions, the more you discover that in some ways this makes sense because it's part of their general portfolio strategy, right? They have a small percent going into high risk assets. And in other ways, when you like dig even deeper on that, you realize, well, it doesn't quite make as much sense because this means that they have massive minimum check sizes, which means venture is not really going at an LP level into mid to small sized funds, which means it's not really going into mid to small sized companies. So I guess there have been so many different moments just around understanding how the capital flows through the ecosystem that have helped me zero in on where there are inefficiencies and opportunities, just in terms of the structure itself of the industry. So it's hard to point to really just one moment, but I think for anyone who's sort of looking for that aha moment, I would encourage you to really dig into where's this money coming from, how is it being allocated, who's not getting it, and why. And really understanding that, because I think that's where a lot of the opportunity lies. And of course, for everyone who's in this program, given your interest in crowdfunding and equity crowdfunding, I'm sure that this is top of mind for many of you. The other aspect I quickly just want to touch on is I had the opportunity really early on, or the good fortune to be in positions where I was given a lot of autonomy and trust very early on, which in retrospect I think is critical for an investor role, because ultimately as an investor, what if you're working at a fund or if you're starting your own fund, you're really being paid for your discretion. You're being paid to make decisions one way or the other. And for those of us who are prone to imposter syndrome, there has to be a way to quickly get up to speed on that and get comfortable with the discomfort of having to say yes or no and having to say we're moving forward or we're not. And so being able to put myself in positions where even if I was just an intern, I was able to screen and respond to and provide feedback to, pitch submission forms from entrepreneurs, or I was able to coach founders for pitch competitions and startup weekends and things like that, and be able to see the impact of those suggestions very quickly in a way that validated that there's something in my perspective that I can add here to these conversations. One thing that helped me in particular was in my earlier roles, I was meeting with a lot of very technical founders, and I have more of a business side background. And so that contrast or that complementary skills really brought to the light that there's a lot that I could contribute in terms of helping them simplify their story, communicate more effectively, hone in on their customers, the use case, the pain point, the business elements of the pitch. So that was something that really brought that to light to me. But again, I'd encourage anyone here to think about what are the areas where you are uniquely positioned, and almost in a sense, what are the types of companies and founders who need that kind of support the most, and spend some time there, because I think that'll really help you identify what it is that you bring to the table and give you more confidence to be able to take on more and more responsibility as you evolve in your investor career.
For sure. I think that's such good advice. And I was definitely absorbing everything you said, because I think it's so applicable to those of us who really want to go into VC and expand in this career, but also think critically as an investor and what it means to get a skill set that will support that kind of longer term goal. And I feel like, just like speaking long term, the longevity of your career is something that I think most of us on this call would hope to accomplish. And I'm really just curious, before we dive into the investing specific questions, how has being at Laconia long term and growing there as an investor added to your own journey as a VC?
Yeah, it's interesting to compare sometimes. Looking at some of my peers, especially, I feel like I have friends who are now on their 5th job in the time period that I'm still in the same role. So clearly, I'm not afraid of long-term commitment. In a sense, I don't mean for this to kind of be a cop-out answer, but I ended up in the very fortunate position where I joined Laconia, not quite on day 1, but on day 2. It was just after the 2 founding partners had put together the very first fund. And I was fortunate that not only it ended up being a great working relationship with the 3 of us and a very strong partnership from the start, but that there was an opportunity to really grow into the role and grow with the firm. And especially in early stage venture, these positions are rare. You either have to start your own fund, or in most cases, roles are rotational, because there just isn't that much room in the partnership to continuously keep adding people unless people are leaving or retiring. And in my situation, I happened to be the first one to join full time. And so there was that ability to grow. I mean, first of all, it helps that I absolutely love what we do and I love my team. So that's something that first and foremost, it's what keeps you in a role versus getting you to really look around. But I think it's also been compelling that there's opportunity to really build a firm from the ground up. And for someone who was looking for a really entrepreneurial role, it was sort of the best of both worlds in being able to invest in early stage companies, constantly meet fascinating founders who are building life-changing companies, but to also be able to do it in large part on my own terms, where I could determine what kinds of companies I really want to invest in, where I want to focus my time, what kind of programs we want to launch. And as someone mentioned, in the chat earlier, we just launched a brand new program for bringing more people into the venture ecosystem. So the ability to have that kind of flexibility and that autonomy, again, has been really, really helpful.
Yeah, for sure. I feel like it's really interesting to hear that, how your time there has added to your perspective and developing it and thinking about long-term, I think, plans. And what's interesting is that in our Venture Fellow and Associate program, we actually talk a lot about what are the steps or what might be the best path to get into VC. And it seems like there are so many different options, although we know the ones that are kind of traditionally more popular. But what I'm really curious about, again, before we dive right into the investing questions, I'd love to hear more about how your time as an operator affected who you are today as like a VC, as an investor, And what are the pros and cons of being an operator before becoming a VC?
Yeah. So my operating experience was actually a little bit different because it's tangential to sort of the things that we're investing in the venture space. So I ended up, when I was still in school, initially tutoring a bunch of students, and then that grew into a role where I was managing a small tutoring and test prep center in Manhattan. And so it was very much an SMB operations role. It was not a software company. It was not a tech startup. It was kind of, old school mom and pop boutique kind of business. And there's not a ton that's applicable there on the scaling side of things, in the sense that, we didn't grow a company from 10 people to 1,000 people and take it public. But it was the kind of role where you were doing everything, right? So you're closing new customers. So there's sales, there's customer service, there's customer support, there's communication with both parents and children. So two very different types of communication. So in a sense, it was kind of training wheels for being able to serve just about every functional role in a company. There were people who I was hiring on my team, training them, onboarding them, really the works. So in that sense, it was just kind of a very comprehensive hands-on experience in that regard. And then the other element that was maybe a little bit more aligned was I spent a couple of months working at one of the TechStars programs in New York. And in that program, accelerators, I don't know if anyone who's on this call has ever worked at one, but they're a very unique structure because especially if you're working not as the managing director who's actually making the investment decisions, but you're working sort of as either an associate or just depending on the structure, some other role where you're supporting the portfolio, you get an extremely close-up view of all of these companies. And you get a perspective that's almost founder level in a sense, that you don't get if you're an investor, and you don't even get it as an employee, right? You really only get it as a founder. So in that sense, it was just, really interesting to be able to be side by side with these entrepreneurs for 12, sometimes 14 hours a day, and seeing them through the ups and downs, seeing them bang their heads against the wall when they're trying to solve a tough problem, really just seeing everything they go through on a day-to-day basis over an extended period of time. And so that experience too, in addition to, a big part of the role is program operations, so just making sure the trains are running on time and helping the founders with all sorts of logistical things. So it was very much extra hands on deck with any tasks that they might need. So help me fix this pitch deck. Can you help me call customers? We have this list of people, just kind of anything they might need. But I think the more valuable part was just being able to really develop a sense of deep founder empathy for what they're going through and a deep understanding of what that journey even looks like day to day. So you just have a reference point of, what goes on in a seed stage startup founder's life. So I encourage, anyone to kind of try to find an experience like that where you can get that up close view if you haven't been a founder yourself. Of course, it's nowhere near the same as actually being a founder, but that to me, I think was just really valuable in providing that close-up perspective that has been helpful when I moved back to a full-time investor role.
Yeah, for sure. I feel like it's really great to kind of hear how what you actually learned being so close with founders and then really bringing that into your VC experience. I feel like it makes sense, and it's really great to hear because I think it gives us a lot to think about in terms of our own involvement and actually understanding what founders go through and how that can help us as VCs or investors later on in terms of understanding what a founder is going through and perhaps just having more or deeper perspective into it. So as you know, the focus of our discussion today was on startup valuation, and we covered from a high level some of the ways that people value startups. And I'd love to know what your initial experience was like first valuing startups. How have you grown since then? And what experiences helped get you there?
Yeah. I caught the tail end of your presentation on valuation. So hopefully this will be mostly consistent with whatever you've all taught the group so far. But in a sense, we think about valuations in terms of supply and demand on a somewhat deal by deal basis, right? So on a micro level, what is the supply and demand for this particular deal currently? And from our perspective as seed stage investors, is this something that makes sense relative to our return expectations? and within what we generally call sort of valuation brackets, right, in general ranges. So this will be very specific to different geographies, stages, sectors, et cetera. But as US, mostly New York-based seed investors investing in B2B software companies, we generally see that pre-seed valuations are anywhere from $1 to $5 million caps or post-money valuations. Seed is anywhere from 5 to 15, depending on the deal, and then Series A is anywhere above that, so 22, and then it gets really, really wonky, right? Depending on growth trajectory, revenue, hype, etc. But that's kind of what we're looking at, and whether a deal ends up being priced at 8 million pre-money or 12 million pre-money, that's largely a function of that supply and demand dynamic, and what really makes sense for the cap table structure. But what we really try not to do is to get too far ahead of ourselves and for the company to get over its skis in terms of where they are relative to their current growth and expected growth over the next 12 months. So the situations that we're really cautious about are if a company has a lot of uncertainty in its growth strategy, if it's still very early on in terms of market data. So maybe there's a robust product, but there's still a lot to be learned about sales cycles, go-to-market strategy, revenue growth trajectory, and all that. For a seed round that's heading, right, ideally to get the company to a Series A, we want to make sure that this company is not overvalued relative to the revenue and revenue trajectory, if that's the core metric that we think Series A investors are going to be looking at before we get there. Because having a post-money valuation of 12 million is very different from having a post-money valuation of 22 million if your next round is not quite going to be a Series A, right? If it's going to be a post-seed or a late seed or a bridge. And of course, one of the reasons we're thinking about this is because ultimately it impacts, our position and our returns. But frankly, it impacts founders even more if all of us end up in a situation where there has to be a down round or a recap or anything punitive that way, because investors are generally protected by anti-dilution provisions to some degree, and we can put more money in, and the founders are usually the ones who get hit the hardest from a capitalization standpoint. So that's one thing that we're thinking through, is really making sure that the companies are in what we think is a reasonable range relative to where we can expect they're going to be within 12 to 18 months when they're raising their next round. And then the other element on a more macro level is really trying to understand what we think the upside potential is of a given deal. And this is where I think sometimes this is different for VCs versus angels, depending on the motivations and the goals of angel investors. But assuming that angel investors, right, and everyone on this call is not doing this just for the learning experience or just for the exposure, but you're investing in an entire portfolio of companies, so it's not just one or two deals. You're building a broader group of investments, and you're actually hoping to make money after all is said and done. Assuming that that's consistent with the objectives of a venture fund, which is to make money, right, to generate returns, and on a sort of crass but true level. Generally, you want to know that the entry price that you're getting in on is low enough to give you the upside that you expect. So if you are getting in at a $10 million pre-money valuation and you expect that this company has the ability to eventually go public or be acquired for, let's say, $100 million, you have to think, okay, if I'm getting in at 10 million, that means I'll make 10x on this deal, assuming no dilution, right? Very simplified calculation. That may or may not be super compelling, right? Depending on your expectations for your failure rate across the rest of your portfolio companies. So in a lot of cases, the way institutional VCs, and I would guess professional or semi-professional angel investors building these portfolios is there enough upside here that I could feasibly make 50x or 100x on this one deal so that in the aggregate, I end up with a portfolio multiple that's exciting. So that's why for a lot of companies, there's this frustration, I feel like, or this tension in the ecosystem where entrepreneurs will think, well, what do you mean it's not exciting if this becomes a $100 million business? What's wrong with you? That's a massive exit. And it is. And we totally agree. It's a massive, massive exit. But in those cases, the venture math for funds just tends to break down. And that's why in some cases, the choice you have as an investor, whether you're a fund or a professional angel, is well, I either don't do this deal because the upside multiple is not there, or I would need to do this deal at a valuation of, 2 million, not 10 million. And in many cases, depending on how the company's been capitalized to date, that's not an option at all.
Yeah, for sure. I think it's really interesting to hear all of that. And you definitely put into perspective a lot of the things that we did go over in the presentation. So I think that was really great to kind of tie it together, some of the things we've discussed. But I guess kind of speaking specifically, Cheryl actually mentioned this during the lecture portion. There is a really big emphasis on getting hands-on experience in dealing with like numbers and performing diligence and then getting to startup valuation. And let's say like not necessarily, people can't always get their hands necessarily on like being able to look through a startup's revenue and get everything answered about that. And so I think the question that the audience and I think a lot of us people have like who are interested in getting into VC is how you think interested people can start practicing startup valuation and building out that skill set before they break into VC, or even just like as an angel investor themselves.
So the question is, how can you start practicing startup valuation? Ooh, I like this. Okay. So I would, if I were in a situation where I didn't have access to private company information and I wanted to see if I have any ability to really get this right, I would create almost like a dream portfolio spreadsheet. And I would start tracking companies that in some way you've discovered. I don't know if it's TechCrunch or Crunchbase or just, LinkedIn, whatever it might be, however you're discovering startups, start making a list of companies that you think are super interesting. And I would maybe track this information in 2 ways. I would, if it's a company that if you had capital, you would invest in, I would track what you think, right, is at what valuation would you invest? So you put it down, you're like, all right, I would do this deal right now. It's just the 2 founders so far. I would do it at a $5 million cap and I'd put in 100 grand. And then track that over time. And as you start seeing funding announcements for this company, in most cases, the valuations themselves won't be public, but you'll be able to get a sense based on round sizes if those are announced. So if a company raises a $5 million seed round, you'll know that they probably sold 20-25% of the company, right? Anywhere from 10 to 30%. So you'll be able to get into a ballpark there. And over time, right, you'll do that with next rounds too. And you could also track what your guess is for what the valuation is at this stage. And I mean, worst case scenario, you'll never find out. Best case scenario, when they go public, you'll eventually find out what all the shareholders in that round bought into. But that's what I would do, and I would track it, and I would try to approximate them based on funding rounds, if that makes sense. And that'll help you kind of track those trajectories. The tricky part there is that I don't know, unless you have sort of inside information in that case, in terms of people who are involved in the company or in the deal, I don't know if you'll ever know why companies were valued at the amount that they were. So you won't know if it's a revenue multiple. You won't know if it's incredibly high user engagement and user growth. Sometimes you'll be able to gauge that from press releases and articles and blogs and things like that from what the companies publicly share. But it's pretty rare that you'll really ever get a straightforward answer. And candidly, like in most cases, the answer is not that straightforward. It's usually someone got really excited and put a term sheet forward and the founder took it. But yeah, that's what I would do. I would try to just base it off kind of publicly available information and create sort of your own internally facing track record of your own bets and guesses over time, and then see how that pans out over the next couple years.
Yeah, thank you so much. I think that's everything from my end, because I do want to be able to answer some of the audience questions that we have right now. So I'm looking for a question, and I actually think this is a really interesting one. Someone asked, how did you leverage your TechStars role to get into VC?
The short and honest answer to that is I didn't really, because I had already interned at 3 venture funds before TechStars, and then I ultimately went back full time to one of those. So it was sort of a boomerang effect, if you will. I do think it helped in terms of getting sort of quote unquote a return offer, or kind of still being wanted in the industry, and that I did end up supercharging my network within the startup ecosystem in that sense. But it wasn't quite the role I played. I did have a lot of colleagues, to the extent to which it's helpful, who actually did use the TechStars associate program exactly as that sort of transition. And for a lot of them, it was effective because the accelerator programs are generally a who's who of people in the industry who are coming in as mentors, advisors, workshop speakers. So if you make it a point to really connect with people and be helpful to them during the program, it is truly an excellent relationship building opportunity for people. And there are many who have gone on to either join startups or other accelerators full-time or funds after being in that role.
Yeah, for sure. And so one more question I think from the audience that is interesting is someone asked, what are the biggest issues with VC and founder engagement and how can this be rectified?
What are the biggest, sorry, say that one more time.
What are the biggest issues with VC and founder engagement and how can this be rectified?
Ooh. So there's generally, oh man, I got to keep this short somehow. This is like a whole 2-hour rant. There are inherently some contradictions and incentives between founders and investors. The key one being that founders are generally working on one thing at a time and have a one shot, and VCs have a whole portfolio of investments that they're managing and a whole lot of shots on goal. So that tension is structural. And there are a couple ways that you can try to mitigate it to some extent. So our fund, for example, takes an extremely concentrated approach, which means that we are not okay with the majority of our companies failing because we don't have that many of them. So that's one mechanism, right? You decrease portfolio size and you increase that alignment. Another one that I've seen, Founder Collective, they don't do any follow-on investing. So their philosophy is we get diluted with the founder, so that creates alignment in that regard as well. So there are ways you can tackle that structurally, but you can't ever really eliminate it, right? It is what it is. It's just a different model. What I think would help a lot is if there were more ongoing transparency about the expectations and the level of engagement between both founders and investors, and more time spent building that mutual trust in that founder-investor relationship. Because on the one hand, I think investors 100% need to do a better job of being clear about what their expectations are, what kind of exit they're hoping for, how they plan on supporting companies or not, right, depending on how many portfolio companies they have. But on the other hand, the founders also need to make sure that they are maintaining those relationships with investors through good or through bad, and really kind of being top of mind and communicative for instances when they end up running into speed bumps. Because for many funds, there's not a lot of incentive to follow on or to provide additional capital when things are going poorly. So I think there's certainly an interest in for founders to make sure that they're building those relationships on solid ground, so that support is there when they need it.
Yeah, you kept it short and sweet there, so that's perfect. Thank you so much. How can people find you? So this is your time to shine. Put your Twitter, LinkedIn, whatever you want.
Yeah, so my LinkedIn, candidly, is a little bit of a black hole because of all the automated spam. So Twitter is better.
Okay.
I'll drop my handle in the chat there. Email is also good, although because of the venture co-op launch, I am behind. But email's good. I'll drop that in the chat too.
Yeah, you want to plug that in real quick, or just tell people what that is?
Yeah, thank you for offering that. So we just launched, we've been doing an intensive internship program for the last couple of years, and we actually just launched a new program called the Venture Cooperative with the intention of being able to scale it up so that we are bringing not just 2 to 4 people into our orbit every year, but bringing up potentially hundreds. So this is an opportunity for people to join our program, get insight to the inner workings of our firm, be able to sit in on investment meetings, and really just get an inside look at how we operate. So there's 2 separate tracks one is for accredited investors who actually want to make an investment, and the other is for non-accredited investors with the opportunity for upside, kind of on a deal by deal basis. So feel free to check that out. We just launched applications today, and reach out with any questions.
Oh, that's amazing. And I will be part of it,
Yes.
which is cool too. So that works out. Plus,
yes, Cheryl is going to be one of our amazing guest speakers. Very excited for the continued Laconia Republic collab.
it's all love, guys. Once again, our community is fantastic, and thank you so much, Geri, for sharing your thoughts and like amazing things in the chat. People just clearly loved what you're up to, and all your answers were extremely thoughtful. So you're the best, Professor.
Thank you for having me.
Yeah, and we actually will, and you can stick around if you want. We actually will have Bryan, who's one of our amazing, investors on the Republic platform, come and talk a little bit about his experience, because he's one of the OGs. He's actually has been with us for a long time. Is engaged with Republic, and so we thought this would be a great 5-10 minute conversation with him around how he personally thinks about investing and valuations and all of that. So Bryan, you want to come up stage? Mm-hmm. Do you need your I'll make you co-host.
It says you cannot start your video because of the host has stopped.
You're now a co-host. Well,
oh, okay. There you go. Hi, hey, good to see you all. Thank you so much for allowing me on the platform.
Yeah, no, this is awesome. Great lighting, by the way. Love it.
I'm trying out here. It's just natural lighting, honestly. It's nothing crazy.
Well, appreciate your time. We actually, the Republic team heard Bryan, and kind of his story around Republic and how much he loves us. And I mean, we cried and we were like, we have to bring him to everyone else and tell, his story. So Bryan, tell us a little bit about yourself and how you came across Republic in the first place.
Yeah, absolutely. And I'm seeing some of the people in the chat are talking about the plans. I don't want to take any credit for that. Those are definitely my wife's. And so I just want them to know she's like a plant boss right now. But right now, for me, investing was something that I didn't see as a possibility. I didn't think that it was something that was necessarily a part that was going to be a part of my life, in that regard. And so I only thought that for the most part we would be able to invest possibly in a stock market, but this whole concept of being able to invest in the private space before companies come out onto the stock market, pre-IPOs, it was almost something that didn't really even register into my mind. It wasn't until my good friend Lau Notice, who's now an associate of mine, where we were working together in partnership, he just introduced me to this concept of equity crowdfunding, and he showed me this website called Republic. And I was intrigued, but I had my share of disbelief and I would say healthy curiosity, but
I don't know.
But also, I didn't want to just throw everything in there. But at some point, I looked at everything, and he showed me some concrete evidence as well. I sat back. And I told myself I have a decision to make, because I'm right now I'm working currently as a youth pastor, and this was about 2 years ago. And so I know I don't make much money in my life, but I know I have big ventures and big dreams that I want to accomplish. And I asked myself the question, what is it that I want to see for my future, and how can I build that? And having that conversation allowed me to sit down with myself and choose to make that one decision. And so it actually happened so that Inamed would be the first company that I would throw just $60 into my investment lifestyle. And that $60 now has exponentially grown for the amount of money that I've invested. But it also, it's one of, I've actually, Stojo would be, I hope that's the way that they're said. Stojo would be my 80th company that I've currently invested in throughout multiple different platforms.
80 companies. You've invested in 80 companies on Republic.
No, so not necessarily just on Republic, but Republic definitely is my highest tier of companies that I have.
So throughout equity crowdfunding, you've invested 80 companies. Yeah, wow.
Absolutely.
Amazing. Talk a little bit about your portfolio strategy. Are you just kind of going and putting your money into different types of industries, or do you have specific ones? Like, do you have an investment thesis? Like, Talk through the decision-making process.
Warren Buffett always, he makes that statement to invest in things that you know and understand. And so for me, I think it's very important for us to invest in the things that you can see, you have an interest in, something that you want to see produce. And so I'm very intentional as to the companies that I put my money into. I want to make sure that these are companies, no matter if it's $100, if it's $1,000, or hopefully at some point $10,000. But I want to make sure that I see a company that I truly enjoy, that I truly believe in its morals and values, and I want to see propel. And so I would say that, and thank you for Republic having that diversification aspect where you're able to see multiple different ways on how you're not just investing in one different stream. But apparently it says that my diversification is excellent. So I'll take that, and I'm happy. I'm happy for that. But I do try to invest not just in one, I would say one way or one focus, like food and industry, technology. I like to dabble in different things, but it's also things that I enjoy. So it's not just every food company that I will invest in, and it's not every. Is my video kind of lagging a bit, or
a little, but we can hear you. It's fine.
Okay. Yeah. And so it's not just every company, every food company, or every tech company that I invest in. It's very important for me. I also, and I would recommend people to to check out and research every single company that you go in. It doesn't matter how much you invest. If you invest $100 or if you invest $10,000, you need to have that same mindset as the research to what you want to invest in and how you want to put that money into it. And so I use King's Crowd. I Google a lot. I'm calling companies. I'm checking things out. My associate and I, Lau, notice we're constantly, throwing companies back and forth towards each other. We built a WhatsApp group just for us to be able to have this time where we can really focus and hone in on what we want to see.
I love that. So you actually also have your little crew that talks through different types of startups and what you guys think about it. And so I think that in itself is a testament, right, to not just Republic having a large diversified portfolio where it's not just also different types of industries, but also different types of founders, different types of locations that are reflected. But at the same time, it's also kind of a social component to all of this, right? Where, really talking through your thought process with others really helps. And I did want to just plug that in because, we do have our Venture Fellow and Associate program. We want to make sure that everyone is connected. And for those of you who are not part of it as well, we did want to democratize access to all of the educational components to it. But you also now have a bunch of people, 300 people here to talk about things. And we actually have a Discord channel that we'll plug in the chat in a second. So Bryan, I would say what's your thoughts in the next year or two around kind of your diversification strategy and overall like startup investing? What are your thoughts around and trends that you want to see happen?
Well, for me, I have, like I said before, I have some big plans. I'm looking to build a youth mentorship program and a center here in Calgary, Canada. And I understand that once again, building your wealth is one of the greatest ways for us to be able to enact some of the bigger visions that we want to see. And so I'll give this as an example because this is actually very recent. I invested, I think it was about $250, and it had come back to me at around 2,230, let's say. And so, and once again, it's not remarkable exponential value, but it's still, I believe it was a 6 or 7x. One of the strategies that I have implemented is to reinvest at least 70% of everything that I get back. And so I'm not looking to just spend the money, take the money and, oh wow, I just made a grand, or I made 10 grand and just end up spilling 5-7 grand. No, as you continue to, it doesn't matter how much you make, as you continue to take in, continue to reinvest, put more in as much as you can. And so that 70%, continues to grow, and then now you're able to now put in more capital into bigger investments. And so, strategy for me right now is actually, once again, the reinvestment aspect, but I'm also going to take a back seat in moving so much or trying to invest in multiple companies. One of the strategies I'm going to be focusing on now is grabbing lump sums. And so I want to invest minimums of $1,000 now into companies. And so I've seen how it's good to diversify, get things going, understand the game, because I think it gave me a very good overview of this whole concept, this whole space of equity crowdfunding. And so now I feel confident to throw in stronger, bigger amounts, 1,000, 2,000, 5,000. And so I'm going to be taking lump sums to invest into into companies that I see have stronger viabilities and possibilities for them to exponentially grow. So those are going to be two of the major things that I want to do at this point. Once again, reinvest 75% of all the money that I make through investments, and then bigger lump sums to be able to invest more. And that'll also allow me to make more in the future.
That's amazing. I think we're a little over time, but I did want to at least give you an opportunity. If there's anything, if there's anything in particular that you want attendees here to take away around your experience or about Republic or around your strategy or just anything else that you haven't touched upon, this is your time. If you want to also plug in anything else that you're building, it's great.
Yeah, sure. I'll start with Republic. Once again, Republic is an amazing platform. I love your diversification, not just in the companies, but how you focus on diversity and inclusion. I love it. It brings me a lot of joy to see a platform like this. And so keep doing what you all are doing, because clearly it's working. So I love Republic for that. You started me on my journey. And so I have to give so much credit to the place that got it all started for me. And then for everything else, for all those who are here, you may be wondering, how do I just spoke with Ken on my podcast, and one of the things that he said was, a lot of people come to him and say, how can I, or how much money should I put in? And the whole thing that he always says is, don't ask yourself, should I invest? You should always be asking yourself, how much should I invest? Invest in your future, invest for your family, invest for your well-being, because as you're putting into yourself and investing in yourself, ultimately you'll be able to make a difference for everyone else in the world. And so I took that away, just for us all to say here today, take the chance, take the leap of faith, move forward, and make things happen for yourself, because the only way for you to do that is if you actually take those initial steps in order for you to move forward. So once again, thank you so much, Republic. You guys are amazing. Bryan, what other what other platforms? I do invest on I'm in Canada, so I do invest in Front Funder, and I've made some good connections with Front Funder, and now I'm actually even helping finding companies to get onto their platform. That's just how amazing I believe equity crowdfunding is. So yeah.
And same for Republic. So if you have any
yes, absolutely. I've actually tried, because I'm not in North America, but I have been trying to send people out to Republic for sure, because once again, you guys are amazing. So I love what you're doing.
Thank you.
Is it okay if I send the link?
Yeah, send the link to your podcast and everything. And so, I mean, thank you again, Bryan. We did not pay him, by the way. This is all genuine. This is all, but I mean, to our amazing community, and you're a big part of it, Bryan. So we appreciate your time. Thank you so much, everyone, for your time as well. Our masterclasses are a little bit longer than an hour, just because we always have too many things to talk about. They are master classes, and so we always want to make it better. So please give us feedback. Let us know Share the love on Twitter, on socials. Last but not least, we have the swag shop that we're beta testing right now. Here it is, plus a little coupon code just to get a little 20% off. So if you guys want anything, or if you have other ideas for swag, please let us know. And last but not least, I want to thank Zehra and all our panelists, Geri and Randy from last week, and all of the people who are just making Republic a really great community overall. We could not do this without you. We hope to see you for a next masterclass. Zehra, who's going to be with us next week?
Next week, we're going to have Anita Rahman from GSV, which is super exciting.
Amazing. And what's the topic?
The topic is going to be on due diligence. So definitely going down like the foundational things you need to know when it comes to startup in VC.
Fantastic. Fantastic. So thank you guys once again for this. And last but not least, if you guys want to continue the chat, here's Discord, which I need to get more into Discord as a platform, but we already have about 300 people there. People can talk about different topics and investing. So please go there. And thank you guys all once again. Have a wonderful Friday, y'all.